slide about a week ago, and I did a, there is some overlap in our presentations, and I took a more sweeping overview, sort of a step back, and what created, what evolved here within the industry, and why they chose to go to the CME to create yet another cocoa contract. So, you know, one of the things that we have to look at is understanding, going back point in time, what caused futures contracts to evolve. And a futures contract means many different things to different participants in the industry. So what I have here is that for people in the cocoa industry, it's a hedging medium, okay? For those who want to, wish to take a long or short position in an exchange, it's an ideal trading medium, okay? For banks, an exchange is a means for which cocoa becomes a far superior liquidity mechanism for them as far as collateral. So an exchange offers different opportunities, different means for different participants in the sector. And that's very important to understand. Where did cocoa trading begin? A long time ago. We're talking about back World War I. There was a boom in cocoa prices. The industry saw a need to have risk managed. And we've had the futures contract develop approximately the same time in both the US and Europe. And they've been side by side competing contracts. There's been arbitrage opportunities between the two. The respective players have used one over the other at various points in time. But these contracts are pretty much the same. There's been some differences in the contracts over time where the exchanges committees have adjusted some of the rules and regulations to adapt to industry needs. Suddenly though, as Jonathan very eloquently pointed out, there was a decision on the part of the industry, okay, that was seeking something different and wanted to address certain issues they felt that weren't being handled or addressed in the existing contracts. And that's how the launch of the CME and the look at what the industry response, what the industry was desiring in a futures contract. And that's how this evolved. And so always a push for a new contract comes from the industry, recognition of a problem. And the CME wanted to fill that void. Jonathan, certainly pointed out many of the differences. So the tack by the CME was to address these problems, and they tried to solve many of them. Okay, so you had the introduction of the contracts earlier this year. Okay, and Jonathan went through some of the features of them. Contracts, the electronic depository to manage warehouse warrants, with cost efficiency. You have contracts priced against bulk and bad cocoa. You have grading based on Federation of Cocoa Commerce standards. So all those are pluses for the CME contracts. In addition, one of the things that is another positive on the contract is a new state-of-the-art cocoa grading facility that's now in Amsterdam. So it puts it closer to deliverable ports for the new cocoa futures contract. So that's something else that had to look at. So by bringing grading closer to delivery port, CME Europe hopes to improve the efficiency and cost effectiveness of future sampling and grading process, and they partnered with SGS, and that helps to ensure the integrity of the process. So all that is certainly a feather in the cap of CME and the industry, which collaborated certainly with the CME to develop and fine-tune to the needs of the industry. Here's the problem, and Jonathan sort of soft-pedaled this one. Most new contracts, unfortunately, fail. Okay, and it has nothing to do with how fantastic the contract is. And the industry might have developed the perfect new mousetrap, but it takes two sides to play. And what has to be looked at is what is the speculative and fund involvement in the industry. And that is a much tougher nut to crack, is to get that participation. Because where the speculative flows are going and all the money assets is based on liquidity. So any of the index funds, so even a mature market like orange juice, FCOJ, okay, which has a limited open interest, is basically not part of the game, and it marches to a different drum. It doesn't have that same fund push, and the liquidity in that market suffers as a result. Fantastic little niche market, but that's its role, and it hasn't changed, and it sort of becomes this self-fulfilling prophecy because you have to get both sides. And what I want to point out is that as world production grows, as the need to increase global stocks increases to keep the stocks-to-use ratio at a comfortable level, that means that the need for hedging increases. And someone needs to be on the opposite side of that position. And that's going to be the role of the speculators. And so to have this new contract successful, the CME handled and addressed the current needs of the industry, but the catch is going to be, how do you get the speculators? How do you hook them in? And now you have this issue of markets are electronically traded. You don't have the locals on the floor to push and help to build up the volumes on a daily basis. And there's thousands of new contract introductions. There's so many new contracts. So when someone looks at the list of contracts, okay, I can trade this. They don't care about cocoa. They don't care about sugar. They don't care about coffee. They care about profits. They care about liquidity. They care about meeting the needs of the investors of a fund and hitting their targets, okay? And that is something that the industry, if they want this contract to survive, because it's going to suit their needs, they're going to somehow have to address this issue. And so that's the perspective that I take. And I want to show from the standpoint of looking at liquidity comparisons. So we have the ICE New York contract, and I looked at September 11th. So total volume for that day, about 20,000 contracts. The London Sterling contract, 26,000. The ICE had introduced a Euro contract in response to the CME contract. Okay, so trading volume 0. CME Financial Futures was 0. CME Euro contract 79. And then you have exchange for physicals. And ICE had 345. You had a substantial amount on the London Sterling, 0 across the board. Spread trading, which is very important to the industry and also for spreading. Again, the established contracts are where the volume is currently. Jonathan raised an interesting point of, we haven't put this new contract to the test yet, but it's going to be very important to see that traction build up very quickly, or it's going to unfortunately suffer the fate of other contracts, no matter how perfect it might be to meeting some of the needs that the industry wanted to address. The open interest is another factor. If you look at the ICE Euro contract, certainly agree with Jonathan that that's probably going to not make it, looking at only open interest of 52 lots compared to 977 in the CME Euro contract. One important factor which comes into play, and it dovetails into what Jonathan was saying about 2016-17 and pricing that contract, is rolling the positions. Okay, so the trade rolls positions, and if they're already in these positions, are they going to roll out of the established contracts into the new one? And what about speculators who are rolling positions and the funds? And so that's also an important consideration of how CME is going to be able to grab some of this volume at this opportune time where the industry has the ability to make a switch if they choose to. And with that, thank you very much.